You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 4th of November 2025, and I'm joined today by my co-host John McEwen. And in this week's episode, we'll be discussing Domino's, Associated British Foods, BP, Shell, London Stock Exchange Group, and our US company of the week is aapl. John, should I start us off with Domino's, a company that I'm newly a shareholder of?
Absolutely. And this is Domino's UK for clarification.
Yes, it certainly is. So this is Little Domino's. So Domino's, who have the license for UK and Ireland, and also minority interest in Domino's Poland for reasons which will remain unknown to us, have come out with their Q3 trading statement. So system sales for the quarter were up 2.1% to 382.7 million. Like-for-like system sales were up 1%. Collection was up 1%, reflecting some continued benefit of national collection campaign, and delivery was down 3.4%, impacted by weaker consumer sentiment across the QSR sector. And the QSR sector is the quick service restaurant sector, for anyone who's not familiar with that term. So overall, collection up 1.7%, delivery down 3.4%, and that meant total orders were down 1.5% overall. Underlying EBITDA is in the range for the full year guidance of 130 to 140 million. They said trading throughout the period has continued in line with our expectations, reflecting the impact of the weaker QSR market on our franchisees and customers' lower discretionary income. Franchisees had to tactically increase price alongside targeted value set deals in order to partially mitigate higher wages and employee taxation and maintain the high service that our customers expect. Total system sales were 382.7 million, up 2.1% versus Q3 2024, and on a like-for-like basis, excluding split, grew by 1%. Total order count reduced by 1.5%, impacted by higher pricing referred to above, particularly in delivery. The tough operating environment is likely to continue to impact order counts into 2026. We have opened 18 new stores in 2025 to date and expect to have opened mid-20s new stores by year end. As stated in the interim results, we continue to assess opportunities for a second brand within our strict financial and strategic guardrails. Consistent with our commitment to return excess capital to shareholders, we completed a £20 million share buyback, taking advantage of the current share price levels. And for context, that's on a market cap of now 713 million. So that's about 2.8% of the share count that was bought back. In terms of valuation, the business trades at 10 times projected earnings and has a dividend yield at 5.88%, and that's excluding the buybacks. So it's returning a lot of cash and it is looking to acquire a second brand. But yeah, as a shareholder, it's a small shareholding at the moment because I'm still building it up. But yeah, I don't really have a huge issue with these results. They're not great. And I think we've historically been used to slightly better results, well, a lot better results from Domino's. However, I think these are fine. I think for the valuation, I think you can't really complain. I think the return's very good. And if they do purchase another brand, I think that would be, well, that would potentially open up the prospect of maybe some more growth in the future again. But even if not, I'm quite happy with the income. John, what do you think as someone who's less biased?
Yeah, I mean, I thought they were slightly disappointing. However, as you say, Domino's, in terms of its valuation, has come right down. So I think it's largely what the market has come to expect. They are buying back shares and it's got a decent dividend yield. I think it is a quality business. It's definitely the best in the takeaway sector. It'd be interesting to see what type of brand they're planning to go after. And also, there are some tailwinds potentially next year with the World Cup. So it's probably not one that I would be looking to buy, but it'll be interesting to see how it fares over the next year to 18 months.
I do think it's quite interesting as well, just because they have basically blamed the economy and the Chancellor of the Exchequer for these results. I think it'll be interesting looking at similar businesses, mainly Greggs, to see whether that is reflected across the board.
Yeah, I think also when you get into delivery too, if you have part-time delivery drivers and the national insurance, etc., hitting them particularly, I think that will have hit Domino's certainly.
Should we move on to a business that I would expect would also have been hit in the main driver, which is Primark?
Well, yeah. So it's a business that is actually similar valuation to Domino's. Slightly different results though. So ABF reported full year revenue of £19.5 billion, which was down 1%, ignoring exchange rate impacts. A 1% increase in Primark sales was more than offset by a double-digit decline in the sugar division due to low prices across Europe. Underlying operating profits fell by 12% to £1.7 billion, with a decline largely driven by the sugar division turning loss-making. Free cash flow more than halved to £648 million, and net debt rose from £2 billion to £2.6 billion. In 2026, ABF expects to deliver underlying operating profit growth at group level, and a review of the group structure is underway, with potential separation of Primark from the food businesses being considered. Total dividends were down 30%, 63 pence a share, and a new £250 million share buyback programme was announced, and the shares were up around 2% in early trading. In terms of valuation, ABF has a market cap of £15.7 billion and trades at 12 times forward earnings, compared with the 10-year average of 16.9, and it has a prospective dividend yield of 3%. I think definitely mixed results, because seeing a 1% increase in Primark sales was encouraging in this sort of broader economy, I would say, in the UK. The sugar division, it's something that we've discussed before, and not a bit that I think either of us are particularly keen on. It's very cyclical, and as you can see, given that it's a commodity, they are price takers and not price makers, and therefore there's not a huge amount there's to some degree nothing that they can do about that side of the business. I guess one of the positives, if you were an investor and you didn't like the sugar division, is that they may be essentially offloading that at some point. I think if you were to look at it more positively, looking at some of the growth areas of the business, particularly in overseas and in the US, they have about 9% of sales coming from the US. And interestingly, about half of the sales over there, the goods are being produced in the US, which has limited the exposure to tariffs. Given that Primark is doing okay, and despite a difficult sort of macroeconomic environment, and then you've got the US growth story there, at 12 times forward earnings, I think that's actually looking fairly cheap. It's not it's probably going to be another bumpy year or two, but should they spin off the sugar division and you get some money out of that, and then growth continues in the US, things pick up a little bit back at home, on paper, I think it looks cheap, and it's a business that I've liked for a long time, and I haven't pulled the trigger, but I think it is attractive. Sam, what are your thoughts on these results from Primark? Sorry, these results from ABF.
I think the results are fine. I think given the broader economy, it kind of is what it is. I think everything feels a bit sluggish at the moment. I do like it. I do like the valuation. I don't think Primark's quite the same quality as Next, but I'd put ABF probably as the second best retailer, I think, on the FTSE. But as we covered last week, I think the Next valuation is a bit higher than what we've gotten used to. I don't know about... It's weird because when you look at the structure of ABF, and I know we don't really cover it that much anymore because we've explained it so many times in earlier episodes, but it's a weird structure, and there's a lot of focus on the sugar division because it is so volatile. But you've also, you've got what's it called? Like they do like pet foods and stuff like that, and weird like agri-foods and stuff like that.
Yeah,
They've
got
like the
Kingsmill, Twinings, Jordan cereals. Yeah,
loads of stuff where it's. And I suppose you look at it, and a lot of it kind of sits fairly well together, and then Primark's just the anomaly. Because the rest of it, you can say, well, actually, they're similar kind of businesses, apart from the sugar, which is a commodity, but then it's still, you can kind of see where it sits in there. So yeah, I think spinning Primark out, I think it probably would unlock value, because I think every time we cover it, Primark is the driver of the growth for the group, or it certainly feels that way. So I think it probably would unlock value. I think Primark on its own would trade at a higher multiple than the rest of it, especially like you say, with the rollout of the US stores, which have been, I think, operated very well, like done very well operationally. So yeah, I think the valuation is attractive, and I think if they were to spin it out, I do think Primark would trade at a higher multiple on its own, and I think that is where the bulk of the value lies.
That being said, would you be interested in shares at the moment?
I think I can see the attraction if you did think it was going to get spun out at the current price. I think probably as like a general rule, I just think it's a bad habit to buy for that reason, because at the end of it, as much as I like Primark and think it's a really high quality business, would I want to be left holding it? And I probably just wouldn't want another retailer.
Yeah.
So I think no for that reason. But if someone else
Yeah.
who was either more comfortable about retail or just thought it was going to get spun out and trade at a higher multiple, I think if they were to make an argument, it'd probably be quite a convincing one.
Yeah. And I suppose if it didn't happen and you still think there is some value in the rest of the business too, then there is more, I guess, more appeal to owning the whole thing.
I think at that valuation, you would have a decent amount of downside protection because it is a quality business there.
Yeah. Okay. On to BP.
Yes. So BP, I'm sure a business that needs no introduction, have come out with Q3 results, and revenue increased $2.5 billion to $48.4 billion, and all their figures are reported in dollars. Underlying operating profit rose 2% to $5.3 billion. The recovery in customers and products, which suffered from a refinery outage last year, more than offset declines in other divisions, which were impacted by lower average commodity prices and a poor results in the group's oil trading operation. Free cash flow more than doubled to $4.4 billion, reflecting improved cash generation and lower capital expenditure. Net debt was up from $24.3 billion to $26.1 billion. After a 3.5% increase in underlying oil and gas output, production is expected to be broadly flat in the final quarter. BP declared a quarterly dividend of 0.832 cents per share. A further share buyback of $750 million is expected to be completed before the next set of quarterly results. And for reference, that is on a market cap of $750 million, so probably about £600 million, and that's on a market cap of just under £70 billion. So not a huge buyback, but then if they're doing it quarterly, it adds up to a good few percent, in fairness. Worth mentioning, BP has been refocusing on its core competencies of oil and gas extraction and has made some notable progress on fresh discoveries and new project startups. So one that's worth mentioning is the Boomerang discovery in Brazil, which is the group's largest in 25 years. However, it does mean that the price or the profits will remain very linked to oil and gas prices, which, as we've discussed previously, they do not set, despite the belief of politicians. And with oil prices at pretty much 4-year lows, it's not great on that front. They have recently made disposals in areas such as wind power, hydrogen, and carbon capture, which shows that obviously that refocus back towards oil and gas. They've also been freeing up capital to try and contribute towards an annual investment target of 13 to 15 billion, most of which is now earmarked for exploration and production. They are targeting a net debt reduction to below 18 billion by 2027, and the 20 billion targeted from disposals by 2027 will help towards that. In terms of valuation, the business trades at a forward P of 12.3, and that compares to a 10-year average of 11.5. The prospective yield for the next 12 months is 5.6%, and that compares to a 10-year average of 6%. I actually think these results are fine. I do agree with the refocus back towards oil and gas. I would view the sort of adventures into renewables, to be honest, to be not that dissimilar to tobacco companies buying consumer brands back in like the 60s and 70s. I just think they need to focus on oil and gas, certainly until you get to a point where I think the renewables are economically viable, which they're just not at the moment. I think in terms of the valuation, I think a forward PE of 12.3 is actually pretty good. The main reason is that's a 12.3 forward PE with the oil price being at a 4-year low. So, yeah, I think it looks pretty reasonable actually. If the oil price were to go up, you'd get a bit of a very nice tailwind from that, and it's still returning good amounts of cash. I think it's probably partly because it probably is a business in terminal decline, but yeah, I think you could do a lot worse at that valuation. What do you think, John?
Yeah, no, I would agree. It certainly doesn't look expensive. I think that BP hasn't been particularly well run in the last 5 to 10 years, but the renewed focus on the traditional oil and gas is certainly, I think, welcome for the group. You compare it with the US peers as well, and both BP and we'll come on to Shell do look cheap. So, yeah, I think you could do a lot worse. I guess one thing depends whether you like cyclical businesses, because these companies are highly cyclical. And yeah, I think politically it has been fairly toxic, and BP and Shell have been singled out in current government and also in the last government. You've had windfall taxes, albeit largely limited to the UK rather than with most of their business, which is done overseas. So that has sort of put me off the sector. I mean, I'll come on to say, with Shell, but I am becoming more bullish again on the sector, I think. I think you've seen renewables unraveling over the past couple of years. And also, I think there's more of an interesting case with energy security being valued more. If you get a bit of a tailwind, if there's, say, more global uncertainty, and certainly if there's a reduction in the production and you see sort of tailwinds coming in, helping the oil price up, then I think you could probably do very well out of both BP and Shell.
So with that, should we move on to Shell?
Yeah, so it's a company, again, that doesn't need much introduction. I did used to own Shell for a number of years, did very well on it, and then when I felt like things got to fever pitch, and certainly when you had the windfall taxes kept coming in, I did sell it. That was, I think, 2023. Anyway, they've had their third quarter results out, with third quarter revenue falling from $71.1 billion to $68.2 billion, with falls seen in upstream, marketing, and chemicals and products divisions. Underlying net profit fell 10% year on year, but came in ahead of both the previous quarter and market forecasts. Most of the good news came from the upstream division and a good performance in the integrated gas division. So free cash flow fell around $900 million to $10 billion, whilst net debt fell by $2 billion over the quarter to $41.2 billion. Shell declared an interim dividend of 35 cents a share and commenced a quarterly share buyback of around $3.5 billion. In the final quarter, upstream and the integrated gas production looks set to stay broadly unchanged, with liquefied natural gas volumes set to rise from 7.3 million tonnes to between 7.4 and 8 million tonnes due to a ramp up in Canada. And the shares were broadly flat on the results. In terms of valuation, Shell has a market cap of £163 billion, so more than double that of BP, and it trades at 11.8 times forward earnings, compared with a 10-year average of 10.7, and has a prospective dividend yield of 4.1%. Again, similarly to BP, I think it's a set of results that we probably expected. The group aren't doing too badly at all, but the oil price being low has hit them. I think one thing with Shell over BP, it does have the best in class in terms of the liquefied natural gas. And in a world with energy security issues, that's massive for them, and they can certainly make a lot of money on that. I think that would probably be one thing that differentiates the two. And also, coming on to the valuation, again, I don't think it's particularly expensive. Certainly, if there were to be a few more geopolitical issues, if the price of oil were to go up a bit, And I think longer term trends that it looks like we're not yet at peak oil and that there are quite a lot of the renewables unraveling, I think all plays very well for Shell. They did explore and go into some of the renewables like BP, but not as big. And I think that's certainly played well from them. They seem to be very well run as a group too. And again, they trade at a significant discount to their US peers. So I think there's a lot going for both companies. You could take a basket approach on them certainly now. I think if you'd asked me a few years ago, I'd have just chosen Shell every time. But now I think you could certainly take that. And yeah, the dividend is not as high as it has been historically, certainly in the last 10 years, but it's not bad either. And if the oil price were to go up, I think you'd see that dividend rise fairly significantly too. Sam, anything to add on Shell?
I think it's quite interesting that they trade at such a similar valuation because although on the surface they are similar, when you drill below,
yeah,
the LNG parts of the business, as you said, are quite different, with Shell having the best in class. So about 70% of Shell's profits come from LNG. It's more like 25% or something like that for BP, I think. So I guess with BP, it's interesting that they trade at similar valuations. I think Shell's higher quality, but I suppose with BP, you've got that cyclicality a bit more with it in that I guess it's probably more a play on the oil price.
Yeah, and I think you've possibly got a bit more of a turnaround going on as they get moved past that venture into renewables that didn't go so well.
Yeah, and I think as well, if the oil price picks up, BP probably from here would outperform Shell for a little bit. I'd probably rather own Shell, I think.
Yeah, and there were rumours, I don't know whether it was 6 months or certainly in the last year, that there might be a super oil major being formed with the two merging, but that's yet to be seen.
I think they should bring back Standard Oil.
Just hoover everyone up.
Yeah, it seems like the kind of thing I feel like the current administration over in the White House may be actually for.
Yeah.
But anyway, shall we move on to LSE Group?
Yes, how are LSE doing?
Speaking of monopolies.
Yeah, well.
So LSE Group, I'm sure for everyone listening to this, London Stock Exchange Group does not need much of an introduction. They have reported their Q3 update and they reported 6.4% organic revenue growth in the third quarter, excluding currency effects, and a 6.5% rise in gross profit, both beating estimates. Growth was broad-based, led by the risk intelligence segment, driven by strong demand for screening and identity verification services. Guidance was largely unchanged, with full-year revenue growth expected to be 6.5 to 7.5%. LSE Group plans an additional 1 billion share buyback to be completed before its 2025 results, bringing total buybacks to 2.5 billion between March 25 and Feb 26, so in a 12-month period. That's on a market cap of just under 50 billion, so it's about a 5% yield, actually. So that's pretty good, that. And the shares were up nearly 7% on the announcement of the results. It is worth mentioning LSE Group is more than just a stock exchange now. So it acquired Refinitiv in 2021, which is a major data and analytics business that has been very well integrated and now actually accounts for most of the revenue for London Stock Exchange Group. In addition to data and analytics, obviously they generate revenue from clearing and settlement. Interestingly, the margins are going up and they've guided for 2.4 billion of free cash flow, and apparently the analysis products are now integrated into Excel and Teams as well, thanks to their partnership with Microsoft. In terms of the valuation, business now trades at a forward P of 20.1. That compares to a 10-year average of 25.3 and has a dividend yield of 1.7% compared to a 10-year average of 1.4. Obviously, if you factor in the buybacks, that yield is a lot higher. I think these are a very good set of results. It's had a bit of a pullback recently, although it's done quite well since these results came out, but it's currently trading at £96 a share. Its 12-month high was £121 a share and 12-month low was £81 a share. I think at a forward P of 20.1, I think that's actually pretty reasonable for a business, because the issue we've always had with it is that we've really liked the business, but it's pretty saturated, albeit a monopoly, so it has the ability to increase prices in quite a lot of areas of the business, but very, very high quality. But it just always felt a bit too expensive. I think the PE was always sort of 30, 40. I think at a forward PE of 20, it's much more interesting. I think the business I'd probably compare it to that I own is Rightmove, and that probably grows at usually 10% a year in fairness, but that trades at about 25 to 28 times earnings. So I think for a business of this quality growing 7% a year, margins going up as well, I think a forward PE of 20, I actually think is very reasonable. And I think it's, for me, the first time we've covered it on the show where the valuation has actually started to look quite attractive. What about you, John?
Yeah, no, similarly. And I think that it being expensive historically, I think had probably put us off, and also put us off digging into it as deeply. So yeah, I think I would be interested. It's difficult to know whether it's one to wait around and just see if you can get it a little bit less. But I think if it keeps putting up figures like this, it's probably not going to be hanging around at that sort of price. And as you mentioned, the dividend doesn't appear high, but when you factor in sort of returns to shareholders through the buyback, does make it more interesting. So yeah, it's definitely climbing up the watch list for me.
Should we move on to a business that's also historically been quite expensive?
So Apple, a company that needs no introduction, obviously started with a Mac. Now it's mostly the iPhone, iPad. They had their fourth quarter results out with an 8% rise in the fourth quarter revenue to $102.5 billion as expected. Growth was broad, with iPhone sales up 6% to $49 billion against $50.2 billion expected, whilst Mac and iPad also saw modest gains. Service revenues rose 15% to $28.8 billion, and operating profit rose 10% to $32.4 billion, and full-year free cash flow came in at $98.8 billion. Net cash, including longer-term securities, stood at $33.8 billion. Apple declared a dividend of 26 cents a share and repurchased $90.7 billion of stock during the year. For the coming quarter, Apple expects revenue growth of between 10 and 12%, with iPhone sales expected to grow by double digits year over year, despite ongoing supply constraints. Tariffs remained a headwind of around $1.4 billion, and the shares were up over 4% in after-hours trading. In terms of valuation, the group has a market cap of just under $4 trillion and trades at 33.5 times forward earnings, compared with a 10-year average of 21.7, with a prospective dividend yield of around 0.4%. I thought these results were fantastic, and you think of a business this size with seemingly iPhones everywhere. Everyone's always talking about saturations. When are iPhone sales going to dry up? Well, they're still putting up the numbers, so it's incredible to see. Impressive, with 15% gain rise in the services revenue. There's also the interesting regulatory win that Apple had, in which Alphabet has been allowed to pay Apple around $20 billion a year to have Google as the default search engine on all Apple devices. I think, you alluded to valuation before, and at the moment, 33.5 times forward earnings for a company that's nearly $4 trillion in market caps seems outrageous. Particularly, I think, with Apple, I think you could make more of the argument for sectors that have high exposure to AI, and if you think that AI is going to change the world. But with a company like Apple, despite it being fantastic, really high quality, but such a focus on hardware and not AI sort of focused hardware, it's difficult to see how you get to that sort of valuation. It's probably one of the strongest brands in the world, but still at 33.5 times forward earnings. I really do struggle with that. And that's someone who has all the Apple products and thinks it's fantastic from a user perspective. Historically, yes, the last 10 years has been average 21.7. It has been a fair bit cheaper. And certainly when you compared it with the other sort of FANG stocks, it's usually been the one that has had the most lowly valuation. But that has changed of late. So in summary, fantastic company, brilliant set of results, but for me, it's overvalued and I wouldn't be buying shares. I probably do have a fair allocation to it in a global tracker, but I wouldn't be buying them directly. Sam, what are your thoughts on Apple and these results?
Pretty much the same. Yeah, I think of all the FANG or the whatever it's called now. I think FANG's quite a dated term now.
Magnificent Seven.
Magnificent Seven, that's right. So of the Mag 7, yeah, like you say, it's probably the one where you'd argue should have the lowest valuation, just because it's mainly hardware. I appreciate Nvidia's also mainly hardware, but I think that's in much more of, as you've pointed out, a growth industry. So yeah, I can't criticize the results. I think it's probably, for a business of Apple size, probably a perfect quarter. I don't think you can really expect any more than that if you're a shareholder. I think that's the problem, because if you're paying that multiple, you do expect more than that. So yeah, just a fantastic business. But I feel I've slightly missed the boat on this one at a 4 trillion valuation.
Yeah, I mean, we're talking about it being expensive when it was a 1 trillion valuation, and yeah,
So what we know.
Well, yeah, I know. It's very hard. It'd be interesting, though, if there were a pullback, if something fundamentally changed with AI, and if everything was revised accordingly and the market took a different view, because you would argue that Apple has a lot less exposure to that. I know they're going to be sort of launching their AI-powered Siri, but generally speaking, when you compare it with the others, I mean, obviously, NVIDIA being right up there, but even if it was, say, compared with Google and Meta, I think, well, I mean, this is impossible to know, but you feel that it wouldn't suffer as hard from that.
Yeah, I'd agree with that.
But equally, at 33.5 times earnings, there's a lot of scope for things going wrong and the share price coming down there.
Did you see the other day? It said, so I think the next generation of Siri is going to be based on Google Gemini.
Is it? I didn't actually see that, because I know that they were using, in that sort of current iteration, they were integrating ChatGPT. So it's quite interesting that there's maybe a shift to Google's AI. Yeah, very interesting.
There's a deal to be done with the web browser.
Yeah. And well, we'll see what happens.
So then, of the businesses then this week, Domino's, Associated British Foods, BP, Shell, London Stock Exchange, and Apple. Which do you like the most and which do you like the least?
Oh, it's a hard one, actually. It is a hard one. I do like BP and Shell for the reasons I've outlined, and I've become a bit more bullish on them again. I'd probably leave them out this time. And then it's really between ABF and LSE. That is tricky. Probably go for LSE. And I think it's that the quality and, more in your right move kind of category. And like you, I've had my fair share of traumatic experiences with retailers.
What would be your least favourite?
I'd probably go for Apple, and that's just on valuation. As a company, it's done nothing wrong. I think if valuation was stripped out of it, it would be my number one by far.
I think mine would be exactly the same, actually. I think LSE top. I think it's the first time I've seen it in an attractive valuation, and it's a really, really good business. Least favourite, Apple, just purely valuation again. I think if you were to offer me any of these 6 in my portfolio, I'd probably, going forward with Apple, you're most dependent on the PE multiple remaining high rather than the performance of the business, which just makes me uncomfortable.
Yeah. Well, thank you very much for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.